Australia's jobless rate hits 3.5-year high, what it means for interest rates and your wallet. In a startling turn of events, Australia's unemployment rate has surged to its highest level in 3.5 years, intensifying speculation about an interest rate cut as early as August. The latest figures are painting a picture of a labour market that may finally be showing signs of strain after months of surprising resilience. But here's where it gets controversial, with inflation still lurking in the background. Should the Reserve Bank of Australia, RBA, prioritise economic growth over keeping prices under control? Let's break it down. On Thursday, data released by the Australian Bureau of Statistics revealed that the unemployment rate climbed to 4.3% in June, marking the highest level since November 2021. This uptick came as a surprise to many analysts who had anticipated more stability in the job market. To put this into perspective, just a month earlier, the unemployment rate stood at 4.1%. While this might seem like a small increase, it represents a significant shift in the labour landscape and could signal underlying weaknesses. Adding fuel to the debate is the fact that employment growth was far weaker than expected. In June, net employment rose by only 2,000 jobs compared to forecasts of a 20,000 increase. This sluggish performance followed a downward revision of May's numbers, which showed a loss of 1,100 jobs instead of the initially reported gain. What makes this particularly concerning is that full-time positions took a hit, dropping by 38,200 during the same period. Even hours worked fell by 0.9%, reversing some of the gains seen in May. These details paint a troubling picture for workers and policymakers alike. Interestingly, though, not all indicators are flashing red. For instance, the participation rate, the proportion of people either working or actively looking for work, ticked up slightly to 67.1%. Additionally, private sector data suggests that job advertisements rebounded in June, reaching their highest levels in a year. And let's not forget that job vacancies have shown signs of stabilizing after declining from their peaks in 2022. So, while there are clear challenges ahead, the situation isn't entirely bleak. However, external pressures are compounding the difficulties facing Australia's labour market. One major factor is President Trump's tariffs, which are weighing heavily on business investment. Companies are now reconsidering their hiring plans amid uncertainty about future trade policies. Combine this with sluggish consumer spending despite 2 interest rate cuts earlier this year, and you have a recipe for potential stagnation. The RBA finds itself in a tricky position. Earlier this month, the central bank opted to keep interest rates steady at 3.85%, defying market expectations. At the time, officials argued that inflation hadn't yet been fully brought under control. They are waiting for third-quarter consumer price data due at the end of July before making any further decisions. Yet, with mounting evidence of labour market softening, calls for action are growing louder. Harry Murphy-Cruz, head of economic research at Oxford Economics Australia, summed up the sentiment well: while we are still not ringing the alarm bells, June's slackening is another good reason for the RBA to get a wriggle on with rate cuts. Analyst Tony Sycamore from IG echoed similar sentiments, stating, "There are clear signs of deceleration emerging in the labour market." This calls into question the RBA's decision to prioritise inflation over growth and jobs at its meeting earlier this month. Financial markets certainly seem convinced that a rate cut is imminent. Following the release of the employment report, the Australian dollar dropped by 0.7% to $0.6480, its lowest point in over 3 weeks. Meanwhile, yields on 3-year government bonds fell by 10 basis points to 3.386%, reflecting heightened bets on an August rate reduction. Market confidence in such a move has risen sharply, with odds increasing to 85% from 76% previously. So, what does all this mean for everyday Australians? On one hand, lower interest rates could provide much-needed relief for households struggling with mortgage payments and other debts. On the other hand, easing monetary policy too quickly risks reigniting inflationary pressures, a scenario no one wants to see unfold. As we look ahead, one can't help but wonder, is the RBA moving fast enough to address these challenges, or is it playing a dangerous game of wait and see? Do you think they should prioritise cutting rates to boost employment, or hold firm until inflation is definitively under control? Share your thoughts in the comments below, we'd love to hear your take.